Hey everyone, and welcome to Da Vinci Trades. Today we're going to discuss the basic definition of options. So what is an option? An option is a contract that you can purchase that gives you the right to buy or sell stock at an agreed price on or before a particular date. You can also sell an option contract that would allow you to sell that same right to someone else and collect a premium for that contract. Slightly confusing? That's perfectly fine, you're not alone. This can seem very confusing, especially if this is new to you. With that said, bear with me for the rest of the video and we'll show you some examples that will help make sense of all of this. Feel free to take notes during the video so you can refer back to them if you need to. Let's begin. There are two types of options, calls and puts. A call option gives the option holder the right, but not the obligation, to buy shares of stock at an agreed upon price on or before a particular date. A put option gives the option holder the right to sell shares of stock at an agreed upon price on or before a particular date. The agreed upon price is what we refer to as the strike price, and the date is what we refer to as option's expiration date. Alright, so let's go over an example. Let's say you bought a call option with a strike price of $150 and it expires in 60 days. Owning this call option would allow you to purchase 100 shares of the stock for $150 each at any time during the next 60 days, no matter where the stock goes. So if the stock goes up to $185 within the next 60 days, then fortunately for you, you own a call option that allows you to buy stock at $150 even though the stock is currently trading at $185. Now, instead of a call, let's say you bought a put option with a strike price of $190 that expires in 60 days. This will allow you to sell the stock at $190 anytime during the next 60 days, no matter where the stock goes. This is great because if the stock dips down to $120 per share, you own a put option that gives you the right to sell stock at $190 even though the current market value is $120. Following so far? It's a lot to digest, I know. So that covers the basics of call and put options. Next, we're going to explain to you why you might want to buy a put option, which, if you remember, gives you the right to sell stock at a certain price on or before a particular date. Now, let's say you just bought a new Lamborghini, and to protect this Lamborghini, you're going to need insurance. So you go to Geico and you purchase insurance that financially protects your new Lamborghini in case you get into a crash. This is the exact same concept as options. So let's say you're an investor and you just bought 100 shares of ZXY stock at $200 per share. So the total cost of this investment is 20 grand. We all know that stock prices fluctuate and stocks can even go to zero if something crazy happens. So your total risk on this investment is technically $20,000. Now, just like we purchase insurance on the Lamborghini, we can also purchase insurance on this investment. We would do this by purchasing an option contract. You are buying an option contract from another trader who is willing to be paid to take on your risk, just like an insurance provider. That is the basic idea of options. An investor has risk, but he's willing to pay someone to take away his risk. The person who gets paid now assumes that investor's risk. Now, say you bought 20 grand worth of ZXY stock and you also purchase a put option as insurance. The price of this insurance is going to be determined by several factors, and you're going to learn about these factors in a later video. For now, let's say you had to pay $600 for this put option, and this gives you full coverage insurance for the next 30 days. The stock price then goes from $135 per share up to $142 per share, so you made $7 per share on 100 shares of stock. That totals to a profit of $700. However, remember you also paid $600 for an option contract that now has no value to you. So your net profit is only $100. If you buy a put option and the stock price goes up, you lose money. Now let's look at another scenario. Let's say the stock price goes down to $100 per share, so the stock share price is now $35 cheaper than where you initially bought it, and since you own 100 shares, that means you've lost $3,500. But thankfully, you bought a put option as insurance. Now you go to the person who sold you the option and say, hey, remember our contract? Now, even though the stock price is at 100, you are able to exercise your option to sell your shares at 135 per share, so you lost nothing on the stock. Your only loss in this scenario is the $600 you paid for the put option, which is much better than the $3,500 that you would have lost if you hadn't purchased this option contract. Now, remember the person who sold you the option had an agreement with you. They were obligated to purchase your shares from you at $135 per share, so they got to keep the $500 that you paid them for the put option. But they are now sitting on a $3,500 loss on the stock that they own. Now, they can hold the stock and hope it goes back, or they can sell it at the current market price of $100 for a total net loss of $3,000. So that's all options are, guys. They are simply insurance for an investor. That's why they exist. Alright, so we've laid down the framework in understanding how options relate to insurance. This analogy is important for you to grasp so you can understand how options are priced, which is something we'll cover in a later video. Now let's look at another reason one might want to buy an option. This time, we're going to explain why you might want to buy a call option. Let's say you don't own any shares of a particular stock yet, but you're checking on a stock that you really like. However, there's just one problem. That stock is way too expensive. So if you were to buy shares, it would require a tremendous amount of capital. What you could do instead is buy a call option. This would allow you to pay a small premium for the right to buy shares at a later date at the specific strike price. So let's run an example. YXZ is currently trading at $200 per share. To buy 100 shares of the stock, it would cost us $20,000. So instead of putting up 20 grand to buy the stock, let's instead buy the 200 strike call option that has 30 days until it expires. This gives us the right to purchase 100 shares of stock at $200 per share anytime during the next 30 days. Now, again, the price we have to pay for this call option will be determined by several factors that you're going to learn about later. But for now, let's just say we had to pay $500 for this call option. Let's look at two scenarios. In the first scenario, after you buy the call option, the stock goes from 200 up to, let's say, 250. At this point, if you exercise your call option, you have decided to take advantage of your right to buy stock at a lower price. So in this case, you exercise your 200 strike call option, so you now own 100 shares of stock at 200. You are up $5,000 on this stock, but remember, you paid $500 for the call option, so your net profit is really only $4,500. Now, you might be thinking, well, if I would have just bought the stock to begin with, then we would have made more money. Yes, that is true, but let's quickly look at one more scenario. If the stock goes down to, let's say, 150 per share, you own the 200 strike call option that you bought for 500, and this call option gives you the right to buy stock at 200 per share. But why on earth would anyone want to purchase stock at 200 if the stock is currently at 150? The answer is nobody. Let's look back to the definition of a call option. It gives you the right, but not the obligation, to buy the stock at this strike price. So owning this call option doesn't require you to buy stock if you don't want to. So in this case, you simply lost the premium you paid for the option, which was $500. If you would have bought the stock at $200 per share instead, you would currently be down $5,000. So that's the benefit of buying an option rather than just buying the stock. You can put up much less capital and therefore have much less risk, but in exchange for that, you'll have to pay a premium. By the way, you can also trade put options this way as well. If you buy a put option without already owning shares of stock, then you are simply betting that the stock will go down, because if you exercise your right to sell stock that you don't own, then you will just end up with a short stock position. So again, if you buy a call, you are betting that the stock is going to go up, and if you buy a put, you are betting that the stock is going to go down. Now, before you go out and start buying calls on every stock you think is going to go up and puts on every stock you think is going to go down, subscribe to our channel so we can keep you informed, because there are big negatives to buying options like this, and of course, we are going to show you much better ways to trade options. One last note before moving on. You don't actually have to exercise your option contracts when you trade them like we showed you in the examples. You can simply buy an option and then sell the option, hopefully at a higher price than you bought it for. We'll cover that concept in the next video. Alright everyone, if you feel we've provided value, smash that like and subscribe button. We'll see you next time on Da Vinci Trades.